Over the past 2 years, an incredible 19 million new small businesses have been formed in the US, marking a historic surge in entrepreneurship across the country. And while this is an exciting time for innovation and growth, it also brings a significant challenge: access to capital. For many of these new businesses, securing the right financing is essential to getting off the ground, expanding, or simply maintaining operations beyond the first few years. But here's the rub. Many small business owners are not fully prepared when they approach a lender, whether it's not knowing how much money they need, misunderstanding the requirements, or being unsure of what documents to provide. And these gaps can be a major roadblock in securing the funding necessary for success. Well, today we're going to break down what every small business owner needs to know before applying for financing. We've brought a great expert who knows the ins and outs of small business lending like few others. Craig Calafati is Vice President of Arkansas Capital Corporation. He has over 30 years of experience in commercial lending, including 25 years as an SBA lender. He's helped countless businesses navigate the complexities of securing financing, and today he's here to empower you with lender-side insights. Craig, welcome to the Small Business Matters podcast.
Hey, thank you very much, Gary. It's a pleasure to be here.
Well, we're very, very pleased to have you on. So let's get into it. You have extensive experience in commercial lending, particularly in building successful SBA programs. How did your background as a former small business owner shape your approach to lending?
I think it gave me empathy, if nothing else. I think I have a better understanding than a lot of lenders on what the day-to-day life is of a small business owner, and so these lenders will say, "Hey, let's set up a meeting for 1:00 and we'll all get together." And business owners going, "Yeah, I kind of work during the day." And so I do have empathy for that. I know what it's like to try and run the small business and be doing other things on the side, like trying to get things together for a loan. And it could be a challenge. So I think that empathy has helped me out a great deal.
And you've been with Arkansas Capital Corporation for about 4 years now. What motivated you to transition from a traditional banking environment to non-banker lender focused on underserved communities?
I half jokingly say I'm paying my penance for being a banker for 30 years. I really did. Arkansas Capital approached me, and we probably talked for about 8 months before I finally decided to come down here. And I actually moved to Arkansas for this position. And it was the opportunity to do some good. I had been running large programs, nationally, top 10 nationally ranked programs up to that point, and just the opportunity to go talk to borrowers again. I was used to only talking to CEO and answering to a board of directors. I actually get to go and talk to borrowers now to help people. We concentrate on helping underserved communities and rural communities, and it's just fun. It's fun to help people and to see that end result, which I'd been removed from for so many years.
That's fantastic. And Arkansas Capital Corporation recently obtained a SPLC license from the SBA, making you one of only 3 organizations to receive this in 40 years. Can you explain what this license entails and how it enhances your ability to serve small businesses nationwide?
Sure. The SPLC license is a small business lending company, and it's a license that's granted by the SBA to non-bank lenders. And there were 14 up until the beginning of this year. They allowed 3 more new licensees, and as you said, the first time in 40 years they had allowed new ones. And what it does is it allows a non-bank lender to lend nationwide as opposed to just their state. Up to this point, Arkansas Capital, we've been around since 1957, but we've been, as far as small business lending goes, relegated to just Arkansas and some of the surrounding communities. This allows us to go nationwide. So what we're doing with that is obviously we're ramping up. We're doing a slow rollout. We're going to first, right now we're operating in the surrounding states and pretty much across the southern United States. We'll take it nationwide when we feel we have all our ducks in a row and the entire infrastructure set up. But for right now, we're going to concentrate on just the South. But that's what the SPLC license allows us to do. It puts us under the regulation of the SBA, and right now we're regulated by the state of Arkansas.
Mm. There's often confusion around SBA loans, with some entrepreneurs mistakenly believing that the SBA provides direct loans. Can you talk a little bit about the role of the SBA as a guarantor and explain the process of working with an SBA lending partner?
Yeah, absolutely. There's a huge misconception that the SBA is another government entity just throwing money out all over the place. And that's not the case at all. It's the SBA is set up. The SBA has been a remarkable resource for small businesses over the years, and what they do is they provide the lenders with a guarantee. So, and what I'm talking about now specifically is the 7A program, which is what most people are familiar with. The SBA provides a guarantee of that loan for, say, on a larger loan, 75% of that loan amount. When the bank goes and makes the loan, they know that if there's a problem and the loan defaults, after all the settlements done and the collateral sold and everything else, there's still a guarantee there from the U.S. government for 75% of that original loan amount, or the remaining, actually, of the remaining outstanding balance will be covered by the U.S. government. And so what that allows is the bank, when there is a shortfall, say in collateral, or the bank can't quite get comfortable with it, they can look to that guarantee and say, well, okay, well, maybe that makes it better. And that allows the bank to go forward and make those loans. That's the hope anyway.
That's great. And ACC specializes in areas that traditional banks often shy away from, like startups and hospitality. What makes your approach to these high-risk industries successful, and how do you manage the risks involved?
I think we take our time underwriting each individual deal. We look at every one of them. It's not a matter of checking boxes with us. For instance, we have everything that we do, our application, our document uploads, everything you need to do the loan, we do online. We have a full online application and all that. And a lot of banks and mortgage lenders will do this too. They have a set minimum credit score that they have. It's usually around 680, maybe even as high as 700. And if you're below that, boom, it kicks you out. That's the end of the story. We have ours set incredibly low. It's 600 actually. It's where we have it set, because I want to look at that individual deal. You might have somebody who has a really terrible credit score, but that's because 3 years ago their spouse had cancer and they had all kinds of medical bills that were unexpected and they couldn't pay them right away and they were sent to collections. This has no bearing on the character of the person, has no bearing on whether or not they pay their business bills or anything else. It's an extraordinary circumstance and they should be heard. And so that's one of the big differences with us is we take that time, we look at each deal individually, and we trust our underwriters. If the underwriters come in and they say, look, yeah, we have these certain hiccups, but these are the mitigations, this is what makes us comfortable with it, then we go forward on that. And we specialize, as I said earlier, on underserved communities, people of color, rural areas, that kind of thing. Banks typically they shy away from that sort of lending. We like startups too. We do a ton of startups. But again, we underwrite the people and we underwrite the business, and we don't go for just checked boxes and, how does this look and how does this compare to everybody else? We take each one on an individual basis.
That's great. Let's pivot to preparing for financing. One of the first things that you advise is for business owners to know exactly how much money they need to get started. Why is it so important to have a clear understanding of your financial needs before approaching a lender? And how can entrepreneurs accurately determine this amount?
Well, it varies by what it is they're trying to do. If they're trying to refinance something, that's one thing. If they're trying to buy a building, that's another. If they're trying to buy a business, another two. But you would be amazed how many people come into the office and they sit down in front of me and I say, okay, how can I help you? And they, well, I want to do this. How much money can I get? And I have no idea because I don't know your business. What I'm looking to you for, especially those initial conversations, is how much understanding do you have of your business? Do you know? You should know exactly how much money you need. You know what equipment you need. You know what you're going to need to operate. You know how much you'll need for advertising and all the other ancillary expenses. You should have a very good understanding of how much you need. That's going to tell me that you've done the research, that you know your business, and that for me is everything. That's what
Well,
I want to see.
yes. And you touched when we were talking previously. Can you talk and elaborate on exactly what business owners should bring to the meeting with their lender? You know, what is the lender most interested in?
Well, again, depending on what they're trying to do, if they're starting a business, we want to see a business plan, and that kind of goes back to the earlier question. We as lenders, any of us, we want to know that you understand your business and what it's going to entail to not only start that business but get it up to speed and maintain it long term. And we want to see that you've done that research, that you have a very good understanding of how it's going to operate. Because how can you impart it to us and make us understand it if you don't understand it? We know a lot about a lot of different businesses, but we don't know anything about your particular business. So
Yeah.
it's really important that they bring that with them. You're going to be asked for a number of different things, tax returns, but tax returns, background stuff, credit information, all that. But that business plan and the projections and everything else, that tells us what you want to do and what your understanding is. And it's also something that's going to follow that loan through the process. So it's going to go to the underwriter. The underwriter is going to read it, say, oh, okay, this is what they want to do, and this is how they're going to do it. And so that document is very important in the beginning.
Yeah. How about checking their own business credit report before asking for financing? That's part of the homework.
Absolutely.
Right?
I mean, your personal and your business, because they both enter into it. It's not just people need to understand that too. Their personal credit is every much as important as their business credit. Some companies don't even really have much business credit, just because they're very small and they're flying under the radar, and so naturally everybody kind of gloms onto your personal credit. And fair or unfair, that's just the way it is, and they look to that to judge the character and everything else. But you should definitely have a good understanding. It's like going to buy a car. Hopefully, when you go to buy a car, when they walk back in the office after you've negotiated, you're not totally surprised by what they say about your credit. You have a pretty good idea. Yeah, I pay my bills. I have good credit. Yeah. So I would have an understanding about all that.
Listening to other interviews you've given, you've mentioned that new business owners don't necessarily need to own real estate right away, and that leasing can be a viable option. Can you elaborate on why leasing may be a better choice?
Yeah, for a myriad of reasons. First and foremost, if you're going to buy the real estate up front, you need that much more money. At minimum, you're going to need probably 10% to put down, and a lot of banks are going to ask for a lot more than that. So that it's tying up cash that you're desperately going to need in the beginning. Lease that building. You may, your business may morph over the first year or two, and you may find certain aspects that you thought were going to be very important to the business are not, and something else became very important. And now your location doesn't work as well as you thought it was going to. Now you're stuck in the thing because you own the building. It's a lot different than trying to get out of a lease and moving to another facility that works better. There are just a lot of different reasons, but particularly in a startup, hold on to your capital. I mean, that's the key. It's typically on a startup, we look for, and this is an anomaly in the business. I mean, most banks want to see 20-25% investment by the borrower in a startup business. We're looking for 10% typically. We want you to hold on to your money. We know that some kid's going to ride by and break your picture window the second week you're open, and you're going to need $1,000 to fix that window. You don't want to close down because you couldn't fix a window. So hold on to your cash, and I think that's very important. And there are very few businesses that have to buy their property. Most businesses can get by with a leased property for, in the beginning in particular.
Yeah, that's good advice. Now, you encourage entrepreneurs to reach out to others who have experience in running a business. How can connecting with seasoned business owners or mentors help in financing, and what should entrepreneurs look for in these relationships?
It can help in several different ways. I mean, just the fact talking to somebody who's been through it, they might help you avoid some of the pitfalls. They can also advise you on their experiences with financing. What they should prepare for ahead of time. What how their lender worked and whether or not they were happy with them or not. We survive and thrive on our customers talking about us. That's the best advertising I can get. So yeah, I would always talk to what was their experience in borrowing the money, good, bad, would they advise going to where they went, that kind of thing. But just in general, talking about the businesses, I mentioned how your business might morph in the beginning that you didn't know. We talked about me being in a small business and I was in the restaurant business. When we initially opened, we were a full service Italian restaurant. Over the years, we morphed into pizza because that's where the money was, and that's what sold. And the first location did not resemble the second and third location. I can tell you that. And so that's where I'm coming from, and a lot of that, that was just experience, and I imparted that to anybody who would listen when they'd come and talk to me. I would tell them the pitfalls and the certain things that I learned the hard way, and you can avoid a lot of costly mistakes.
Yeah, and I can see how your direct experience as a restaurateur um, brings value to your current role as an executive on the finance side,
Absolutely.
because you bring a certain empathy to those conversations. You know what it's like to be maybe in the early startup phase or in the struggling phase, right?
Right.
Now,
No,
you mentioned the importance of micro lending, particularly for businesses that feel it's hopeless to apply for a loan. Can you talk about the challenges these businesses face and how micro lending can provide a solution?
yeah, microlending is interesting. We're starting a microlending program right now, and it's very interesting because, and what it is, to be very frank about it, banks don't want to do little loans. It's not costly. We are going into microlending knowing that we're not going to make money at it. It's strictly mission based for us. We believe in it. Um, and we happen to be fortunate enough we make money in other things that we do because we're a nonprofit. And I'm not a bank, so I don't have other people giving us money to lend out. But we've got to raise that money.
Let's talk a little bit about the pandemic and how it forced many businesses in the restaurant and hospitality sectors to innovate quickly. Yeah, from your perspective, what lasting changes have you seen in these industries and how should new businesses adapt?
I think really one of the biggest things that we saw was so many things going online. Meaning, with ordering and contactless pickup and that sort of thing. I think it trained a lot of people to start doing things online, to not show up at a restaurant, for as an example, show up at a restaurant to order to go and then wait there to pick it up and that kind of thing. So a lot of these places they adapted, they created, ways to do takeout, ways to do delivery that didn't exist before. They had to do them to survive. And so you're seeing a lot of that, but the people adapted it too, and in a lot of ways they decided, hey, we like that a lot better. You can see in the banking business is a great example. They were starting to downsize ahead of time, but the pandemic really showed a lot of people that I don't have to go to a branch bank anymore. I can do all that stuff online, and so now you're starting to see a lot of banks, not so much in Arkansas, but in other states, they're closing down branches. They're learning from it, and other businesses have adapted the same way.
Yeah. I like the change. I do. I've
No, I do
become
too.
very accustomed to, I mean, Sweet Greens is a great brand. I'm not sure if you have
Mhm.
them down there in Arkansas, but they've
I,
got the full digital experience. Pick up the food. I mean, you can eat it in some locations, but they've got that nailed in terms of making it just easy for the customer to just go in, grab, or even have it delivered, and the delivery services as well. I mean, I do lean on those because you get time back in your day
yes.
in a lot of cases. And then if you want to go out and be social with people, you still get into restaurants. So I
Sure.
think it's an exciting change, and I think we're seeing some of that, kind of bleed into other industries too. So it's really cool. And now we've got AI. We didn't have AI during
Right.
the pandemic. Now AI is really powering a lot more. The new phones from Apple are real exciting.
I
They're
know.
going to have Apple Intelligence built into them, so I
I'm
can only
waiting to buy
imagine that it's
my
yeah,
iPhone 16 here in a little bit, so I can
yes,
take advantage of that. Hey, one thing I did want to bring up, and this is something that I think is apropos to this conversation, and something that changed with the pandemic and is still a long lasting effect. And new businesses in particular need to think about this. When you're doing your business plan, labor is a big problem right now,
mm,
particularly when you're looking for uh, minimum wage or that strata. So if you're opening a restaurant, if you're opening a retail establishment, anything where you're requiring people on the floor, lower end paid people, they're difficult to find now. And I ask people all the time. They bring me, I keep going back to restaurants, but it's a good example. I look at their business plan, and they have between lunch service and dinner service and 7 days a week, they have 30 to 40 employees they got to hire. Where are they going to come from? You start talking to small business owners out there, they are struggling. They're cutting back hours. They're doing a number of different things because they can't find the people. So that's something really to think about when you are doing your business plan or you're thinking about expansion or anything else, is the labor pool isn't what it used to be. And you need to really think about that.
yeah, yeah, definitely. So when we talked earlier, you hinted at a name shift for Arkansas Capital Corporation, moving toward the ACC brand. Can you share a little bit more about that and the reason behind the shift and what it means for the future growth of your company?
Sure, I think it's just in keeping with Arkansas Capital's mission and what we plan on doing. That as we go nationwide, ACC seemed to make more sense as a name than Arkansas Capital, just because people would automatically think we are located in Arkansas, and we're proud of it, but that we only served Arkansas, and so we think ACC is just a better way to go about it. We'll start rolling that out the next few months. I think it'll just better identify what we really do, and so you'll see that in the next few months.
And that's a good opportunity to expand into those underserved communities and small
Yes,
businesses that haven't had access to capital. So that's exciting,
absolutely.
Craig.
Yeah, and we talked about this earlier. I touched on it briefly, but the thing with the micro lending with banks, they don't want to do the small loans because they just don't make sense financially for them. They take a lot of time to do. The banks also don't really typically like rural settings. If they end up with properties they have to sell, they can sit for a long time, and shareholders don't like that. Shareholders don't like it when you have businesses out in the middle of nowhere, or it's mainly the small thing. It's not just the banks. A lot of banks want to do the smaller loans. The loan officers just don't want to mess with it. Let's face it, a lot of loan officers work off commissions, and they have a choice of doing a $30,000 loan to help out a business get started, or a $2 million loan to help a business buy a couple trucks and a garage for it. They're going to do the bigger one that they make more money off of, and it's unfortunate, but it just happens to be the way the business is set up. And
Yeah.
so we're excited about getting into micro lending. We think we can do a lot in that space. There are a lot of people clamoring for it. It's getting through to people and convincing them that, hey, I will actually listen to you, and I am interested in helping you. I'm not going through the motions here. I'm not going to bleed you of all your information and then say, well, sorry, it's not for us. We're serious about this, and it's part of our mission, and we believe in
Well, Craig, this has been so helpful. I got a lot out of that. Can you
it.
let our audience know how best to get in touch with you to start a conversation?
Actually, the best thing to do is go to arcapital.com. It's Arkansas Capital's website. And there you can not only find all our contact information, but our applications online. You could apply right then and there if you'd like. And it's all automated. You'll go through, you'll fill out everything. Then there's a next page, it'll tell you what documents you need. And it's very straightforward. There's always somebody you can contact if you need help. And that's what we're here for. So I really appreciate it. Thank you very much, Gary.
Craig Calafati with Arkansas Capital Corporation, soon to be ACC. Thanks very much for coming on Small Business Matters podcast.
Thank you.